This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello there, I'm Danni, and it is Thursday lunchtime, and we have just had the latest decision by the Bank of England's Monetary Policy Committee. And I thought I'd bring you this before we bring in the rest of the episode, because, of course, we recorded it before we had the Bank of England decision and that of the United States Federal Reserve. That said, we kind of figured that it wouldn't be an issue, and both central banks have delivered exactly what had been expected. And that was, well, nothing, a hold in both cases. It was interesting to note, though, with the Bank of England, they voted by a majority of 8-1 to hold the base rate at 4.5%. One member voted for a cut of 0.25 percentage points. But clearly there's an awful lot of instability around. And in the minutes of the meeting, you did see that the MPC mentioned that global trade policy uncertainty intensifying, which was one of the reasons that they've decided to keep rates on hold. We also had the Federal Reserve doing exactly the same thing. Jerome Powell, the chair of the Federal Reserve, coming in for quite a bit of stick from the United States President Donald Trump, who took to Truth Social, saying the Fed would have been much better off cutting rates as US tariffs start to transition, in brackets, ease their way into the economy. But the Federal Reserve said, look, at the moment, we just don't know quite what's going to happen. They have downgraded the growth expectations for the United States for the year and also uprated the inflation expectation. Where rates go from here, a lot now depends on what happens with tariffs. A lot in the UK depends, of course, what happens with Rachel Reeves' spring statement, which is coming next week, and we'll have a special episode all about that. But just taking a look at today's jobs figures, they didn't really give any indication for Monetary Policy Committee members about what potentially might happen, because everything stayed as it was. So unemployment stayed where it was, wage growth stayed where it was, and vacancy numbers, yeah, you guessed it, they pretty much stayed where they were as well. So we'll keep tabs on it. Obviously, markets in the UK after the Bank of England looking not particularly feisty in the red today, although following the Fed's decision, we did see United States markets pick up a bit. And that is because they're taking their foot off the quantitative tightening there a little bit. So we'll keep an eye on it. But now it is time for our regular episode of the AJ Bell Money and Markets podcast.
Hello and welcome to the latest episode of the AJ Bell Money and Markets podcast. I'm Charlene Young, and joining me today is Danni Hewson. Hi, Danni.
Hi, Charlene. Sandwiched between last week's ISA special and the upcoming spring statement. It has been a bumpy week for US markets. So I've drafted in our very own AJ Bell investment director, Russ Mould, for his wisdom on the Trump slump and the not so magnificent 7.
And in a week where VR headsets and yoga mats were popped into the inflation baskets, the battle for where we fill our supermarket baskets and trolleys looks set to enter a price war. We've also had updates from Trustpilot and Qinetic, and Tom Sieber from Shares Magazine joins us for his regular slot. This week, he wants to talk about stock splits. Why do firms do them, and how do they work?
Let's canter through a quick bit of markets news before we hear from Russ about what is going on with US markets, which have definitely been looking a bit forlorn of late.
Yeah, and that could have something to do with gold hitting record highs. The precious metal hit $3,000 an ounce for the first time ever last Friday. Danni, what has driven the value store to record highs?
It's definitely got a lot to do with US markets looking forlorn, as I say. What happens with gold is that it's often seen as a safe haven, a bit like the dollar. But of course, if the dollar's not looking that great, if it's losing value, then people are looking elsewhere. And I've seen a lot of people describing what's been happening with the price of gold over the past week or so as the panic asset of choice. I mean, that just sums up the mood right then and there. there is real concern about the state of the US economy. A lot of speculation that it might be heading towards a recession or a Trump slump, Trump session, however you might want to put it. I love the use of his words when describing all the talk about a recession. It's not nailed on by any stretch of the imagination, but certainly, as we're going to talk to Russ about, we have seen US markets enter correction territory. And people are effectively looking for somewhere to put their money at the moment, something that they expect is going to hold value. And of course, when you think about gold, when we're talking about going for gold, when we win an award, it's always the gold medal that people want to get. For years and years, it has been seen as something to aspire to, something to, buy, something to keep. And certainly in terms of an investment, it's something that a lot of people do turn to at times like this. And I was taking a look, and actually, if you were looking back to November 2023, gold pushed back above the $2,000 an ounce price at that point. So, it's gone pretty much gangbusters since then. And there's been a 60% jump in the value of gold since Russia invaded Ukraine in 2022, February. And it's sort of that political uncertainty, when you're talking about war, geopolitics, all that kind of thing, people then tend to look at gold. Although, of course, for some people, having to pay to store it is an issue. So I know that you can find now some funds that track gold, which might be a potential option. And also we spoke at length to the Royal Mint not so very long ago, talking about the fact that if you're buying gold coins, then they're capital gains tax exempt. So that is something certainly to consider as well. But what I did note is that we had an update from the UK's largest pawnbroker this week, H&T, and it's seen profits jump by 10%. It's hit a new record high. Now, some of that is because it's selling watches and jewelry, gold is in there, but also because it is seeing more and more people using its services as a pawnbroker. So its pledge book is up 27%, with the last 10 weeks of the year seeing a really big push as people who maybe wanted to buy their loved one Christmas presents or were thinking about, paying, unfortunately, electricity bills and things like that. The boss there was saying that it's one of the only places where people can really go to get short-term cash, particularly when you're thinking about interest rates where they were. And Chris Gillespie says that the potential for more unemployment over the next year and the continued impact of a cost of living crisis, which hasn't gone away, added to the fact that we're seeing gold hit these highs. All of those things are really shaping up to be another good year for this business.
Thanks, Danni. I think that the kind of dual aspect of that's really interesting, because we sort of focus on, like you say, the flight away from traditional investments, if you like, more liquid investments. And then we're talking about gold as a store of value. But there is that other real world impact of like people trying to still make ends meet, like you say, and, maybe getting rid of loved heirlooms to actually just make ends meet. And I think, it's important to kind of like look at both of those sides.
It really is. I think you're absolutely right. And I think when we're talking about money at the moment, we have to factor in the fact that a lot of people are still dealing with a cost of living crisis, and trying to find any way to make ends meet is what they're doing. And certainly a lot of businesses are hyper aware of that, and supermarkets, one of them.
Yeah, onto some of this UK company news. And I think it's fair to say the market cap of big UK listed supermarkets, our Tesco's, Sainsbury's, M&S, have taken more than just a knock. I think I saw some of your comments referring to it as an absolute beating.
Yeah, we had over 4 billion wiped off the market cap of our 3 listed supermarkets. So I'm talking about Tesco, Sainsbury's, and I'm including Marks and Spencer in this because a lot of people do their weekly shop at M&S. And shares, were down significantly after the news on Friday from Asda that it was looking to invest in cutting prices. So we know that Asda, Morrisons have really struggled with market share over the past year. And Asda in particular is now trying to find a way to get people back in store. And when you're talking about a point where people are worried still about the cost of their weekly shop, any way that they can cut prices and wave the flag that they're cutting prices, they hope will get people through the doors. So the prospect that maybe margins will be cut even closer to the bone than investors had perhaps thought. We know supermarkets are among the biggest that are going to be impacted by these changes to national insurance and increasing the national living wage. And there's huge competition in that sector as well. So we had an announcement from Tesco this week saying that it's going to lift wages to more than the national living wage to try and keep people in the stores. But yeah, I mean, it's a fascinating period of time. Whether or not it's going to make any huge particular impact to us when we go to the supermarket, when we fill up our basket of goods, and I know we're going to talk a bit later on about the basket of goods that's used to clock inflation, I think it's a bit of watch this space, really.
Yeah, and I don't know if I've just sort of manifested this as we've been talking about it, but I'm sure I saw the old Asda advert making a comeback. You know, it's that Asda price and someone slapping their own buttons. I'm not sure why I've gone on this massive diversion. But yeah, that's just popped into my head. I'm sure that's come back as well. So it's, yeah, really Asda kind of calling back on that kind of value play.
It's a bit like John Lewis, though. I mean, they've gone back to the never knowingly undersold, because at a time when people are concerned with value, sort of shouting about the fact that you are the best value. And that's why the discounters like Aldi and Lidl have taken up such a huge amount of market share, because actually going and shopping at these stores, getting a really good deal has become a bit of a medal of honor. You know, just a few years ago, it used to be that you wouldn't want an Aldi or Lidl shopping bag. You might take your Marks and Spencer's shopping bag with you. So when you walked out of the car park, people weren't saying, oh, you've shopped at Aldi and Lidl. Now it's like, hey, I've got my Aldi bag, because I tell you what, I'm looking at value wherever I can.
Yeah, I've even seen some Lidl merch along the way. And I know kind of near where I live, the M&S food and the Aldi are right next to each other. So, you know, kind of complaints before maybe that you couldn't do your whole weekly shop at one. Yeah, it's probably like opposite ends in terms of value. It depends what you value. But yeah, you can kind of spread across both. I quite like that.
We've got the same. We've got that, and we've got home bargains on the other end as well. So you can do your full weekly shop, pop into M&S, get your little treat, but you know, you've got your value ranges all sewn up there.
There we go, some free tips. Right, so let's wrap up with some other bits of company news. What else has caught your eye this week, Danni?
Well, I wanted to talk about Trustpilot. It saw shares really soar in early trades, although it did sort of lose its way after it announced a double-digit increase in revenue and earnings. Really, brand awareness has, in inverted commas, fueled the flywheel. That was how CEO Adrian Blair put it. They said that in 2024, they've delivered record bookings, profitability, cash generation, also returning 33 million quid of capital to shareholders through 2 share buybacks. Look, you know, people really are now hyper aware of what they're buying online, and making sure that you are buying from a reputable vendor is a real must for many of us. And you know, that kind of customer feedback, if you can be sure that the customer feedback is fair and accurate, then I think it's the kind of thing that many of us look for. I mean, do you ever use Trustpilot to get an idea of what you're maybe considering buying?
Yeah, definitely. And I think, you know, with the rise of sort of things like Instagram and influencers, I think people are starting to take some of that with a pinch of salt. Obviously, they're really valuable partnerships for some companies and really valuable for customers who, you know, might like the fact that someone like them or someone they aspire to likes a particular thing. But yeah, no, I like the kind of the independence, if you like, of something like Trustpilot, and the fact that they are more verified reviews than perhaps other sites.
And of course, you know, in an age of AI, it's becoming even more important. And that is something that the CEO was talking about. You know, trust in this age it becomes a currency, really. And for them, they're seeing that this is now an opportunity really to provide unique insights into, consumer behavior and market dynamics as well. So that was one company which has done pretty well this week, though, as I say, mixed reaction from investors over the course of the day. Investors absolutely sure that they were not happy with the update from British Defence and Security Group Qinetic. Shares dropped a fifth. I mean, absolutely plummeted. Because of all the talk recently, we've seen shares in the defence sector absolutely shoot up. The UK saying it's going to spend more on defence, Europe saying it's going to spend more on defence. But we know that a lot of Qinetic's contracts have been hung up, been stalled, and that led the company to issue a profit warning. So it's particularly been impacted in the United States. It has had to set aside quite a chunk of cash, £140 million goodwill impairment charge because of what is going on there. It is taking a good long look at that US market. It is really getting in and trying to deal with it there. But yeah, we've had a review of the defence sector here in the UK, and that has delayed some contracts. Also, proposed cuts to defence by the Trump administration in the United States has also created an issue for the company. So, investors were displeased with what Qinetic had to say and showed their displeasure with quite a significant share fall.
Thanks, Danni. Now, we've mentioned across the pond, and we've got to talk US markets. Torrid times, I guess, as they cross into what you've referred to as kind of that correction territory. Again, we've mentioned, fears of a recession have turned that kind of Trump bump post-election into a Trump slump, I think we were referring to it as. So, Danni, you went and you've spoken to our own Russ Mould, AJ Bell Investment Director, to kind of help us understand a bit more about what's going on and why the Magnificent Seven are looking a little battered right now.
Russ, we're obviously talking on Wednesday morning before we get the latest from the Federal Reserve on their interest rate decision. I just want to put that out there. But I think in this case, we're pretty safe because we're not expecting any changes from the Fed, are we?
No, we're not. And the Bank of Japan has already stood still. The Bank of England's expected to stand still. And the only other one of the big four that's expected to do anything this week is the Swiss National Bank, which is expected to cut. It's not quite in the tariff firing line like the Bank of Canada, which cut last week, but I guess it shows that, at least in theory, the direction of travel is lower, albeit perhaps not as quickly as investors would have been expecting or liking to see even 6 months ago.
I mean, investors, they just seem nervous at the moment, and I guess for good reason, because with Donald Trump, we don't know what is coming from one day to the next. And you can wake up at 4 o'clock in the morning and suddenly find that you've got brand new tariffs on Canada or Mexico or China. And then you can, look back a few hours later and it's an about face.
But it's kind of interesting because everybody the markets treated Trump's first victory with a great degree of caution and circumspection. Last November, they were behaving as if they couldn't believe their luck. I mean, the market did go up very, very strongly, and particular sections of the Magnificent Seven, like Tesla, went up particularly strongly. So, in that respect, there has been a change of sentiment, and I guess the issue is that you've got high valuations meeting high expectations, meeting a degree of policy uncertainty or lack of clarity, and I think markets were all very excited about tax cuts and deregulation, but they forgot that the tariff deal was part of the package. And I think that's probably been the cause of upset. And if you're a company, it must be pretty hard work at the moment because you're trying to work out are tariffs coming in, going out, going up, going down, when are they coming in? And clearly the economic statistics from the US show that there's been inventory build, that companies are trying to prepare, they're putting hiring on hold. And so I think the net result is you're going to get some very, very muddy, very messy first and second quarter economic data. Now, that doesn't mean that everything's dropping in a hole, but you did have a scenario whereby markets thought America already was great because it was 2/3 of global market cap, trading at big premium to most other markets and at record high valuations on several counts. You already had double-digit forecasts, percentage growth forecasts for corporate earnings. So expectations were high, valuations were high. Numbers might back it up, but at the moment it's less certain than it was. And that's why seeing this bout of nerves that I think that we've got right now.
We've seen some banks like JP Morgan sort of upping their expectation of a recession in the United States. And as you say, some of the economic data we've seen perhaps hints that certainly the consumer is really wary about the path that inflation may go. But it's quite interesting when you start digging into some of investor thoughts about this Trump slump, about this recession, that investors, as you say, back in November, they really weren't factoring any of this in.
No, I mean, again, given those high expectations and high valuations, the one thing that isn't priced in is a recession. And that we can say with a fair degree of certainty, even now. Whether we'll get one or not, I genuinely don't know. But I think the numbers are going to be muddy. We are overdue one. We haven't had a recession since 2009, apart from the short, nasty one we got because of COVID. And I think the challenge that you've got is at the moment, you do have a Trump administration that is slightly going down the austerity path in terms of the Department of Government Efficiency. And Scott Bessent, the Treasury Secretary, he talks about the bond market all the time. He never talks about the stock market. Trump is talking about the bond market. He's not talking about the stock market. So again, this is a big difference from what we've been used to. Federal support, Federal Reserve stepping in as soon as the markets get wobbly, or the White House offers soothing words or policies or fiscal stimulus. That's not happening. And I can understand why Trump and Bessent are saying what they're saying, because the US federal debt is $36 trillion and rising. It's 120% of GDP. The interest bill is $1.2 trillion, which is the fifth of your tax take. Those are the sort of numbers that when you add them to a current account and a trade deficit would have embarrassed a tin pot republic 20 years ago. Now, you only get away with it now because everybody's in the same boat to varying degrees. But I can understand why Bessent and Trump are looking at trying to raise tax income through tariffs, trying to cut spending, because those numbers are not necessarily very sustainable. Or if they are, then you're going to end up seeing your treasury yields go up, not your treasury yields go down, and your interest bill's already uncomfortably high. So I can see exactly what they're trying to do. Whether you agree with it or not, I know what they're worried about, but there are going to be potential consequences of their potential solutions. Nobody's factoring in austerity. You've got a stock market that's been used to loosey-goosey monetary or fiscal policy for a very long time. That's why corporate profits are record high. It's why corporate margins are a record high, or a big contributor to, not the only reason why. There are some fab companies out there doing fantastic things, but they're contributors, and austerity doesn't really fit that narrative.
You mentioned the Magnificent Seven earlier, and we have seen the market cap on 6 of the Magnificent Seven, which I know has prompted a lot of people to wonder whether or not we need to change the name again, or why we have these names in the first place.
Famous 5, chop out Apple as well. Well,
there you go. You see, a lot of people are very concerned about the Magnificent Seven. And when you look at things like global trackers, they form a huge part of those investments. And a lot of people will have their ISAs, their pensions, have a great deal of exposure to these. Do you think that the narrative that the Magnificent Seven is badly tarnished is accurate? Or do you think that, because they're still making a lot of money in many cases, the likes of NVIDIA?
They're hugely profitable. All right. Tesla's profits halved last year. There aren't many companies get a free pass for that, but Tesla largely did until this year. So I know that every time I say something that questions Tesla, I tend to get a fair degree of grief on social media. So I'm not saying it because I want to cause trouble. I'm saying I'm just trying to explain what the thought processes are and where we are now. And the profits halved last year and the numbers stank. And so for the stock to rocket as it did late last year was interesting and speaks clearly of people's very great faith in Musk and very great faith in the company's long-term roadmap for a wide range of product, not just automobiles. And that is still, if you're a bull of the stock, a big part of your investment case. But overall, fans of the Magnificent Seven film will tell you that only 3 of them survive, by the way. So that's always something that's worth thinking about in itself. But on a macro basis, we've talked about the challenge that you've got there of high valuations, high expectations, rates not coming down as quickly as expected. So there is a macro sheen to this. There's a micro sheen to this, which is, you've got extremely high valuations all right, they've come down a bit, but they're still trading in a premium to a US market that's trading in a premium to the rest of the world with, I think maybe Alphabet's the only exception that might trade at a discount. And then you've got, look at the companies, look at what ultimately does in any company. It's one of three things or a combination of them. It's competition, it's customer disaffection, and it's regulation. And so if you're looking at what could fundamentally gnaw away at them, those are the things that you have to look at. And it varies from company to company. Amazon's got competition, but it's kind of flattening most of them. Tesla has got competition coming out of its ears, and this is a fundamental challenge for it, right? Apple is not short of competitors in the hardware business by any means. Its Chinese business is under pressure. The tariff and geopolitical situation isn't helping, and it's got regulatory pressure. The DOJ is still investigating Google paying it $20 billion a year. So Google is the leading search engine on Safari. If that goes, that's a chunk of Apple's service revenue gone, and services has been a big part of the Apple story. So you need to look at each of those companies individually through the prism of those three challenges and see how well you think they are prepared to withstand them, how well they will withstand them, and if there are any issues, what does that do to that precious cash flow that you talk about? Because a lot of them are chucking out dividends, share buybacks, and they're still copious cash generators, which is part of their investment appeal for many investors. Although most people, I think, probably view them as growth companies, not dividend payers or buybackers. So again, there's a multiple thing there. If you probably pay one multiple for growth and a lower multiple for cash flow and for the cash flow oriented income angle. So that's the way you've got to look at it. If you're looking for, what could go wrong. We all know what can go right because they're amazing. They've done amazing things. But if you're looking to protect your downside and just double check yourself, they're the questions you'd ask. Competition, customer disaffection, regulation, and then put that in the context of valuation. And we've seen how much they've gone down. I've just quickly done the numbers before we sat down. They've lost $3.4 trillion of market cap since Christmas Eve. That's the same as the market cap of the UK.
When you put it like that, it's quite an eye-opener. And I was just taking a look at the S&P, the NASDAQ, and comparing them to European markets, because there's a lot of the newspapers now looking at where the money is going. Gold, obviously, has hit record highs as people consider safe havens, but also European markets are benefiting from investors pulling money out of the States and maybe thinking that Europe, it's time.
I was reading a blog the other day, and he nicked this from somebody else, so I'm nicking it from him. But he put up a chart that showed that I think there are either 35 or 40 country ETFs that have outperformed the S&P 500 ETF this year. Now, the mood music kind of feels like it's changing. Now, you go back to gold, since November 23, and I'm nicking this from social media, but I have checked it and it's true, Microsoft is flat and gold's up 50%. So you can feel a change in the market mood music. Now, this to me feels a bit similar to 2022, when this Magnificent Seven crew also had a really tough year share price-wise, in that was when markets were looking at inflation, they were looking at nominal growth, and they were looking at interest rates maybe being higher for longer. And it kind of feels a bit like that now because, all right, America is going down the austerity path. The UK doesn't really quite know what to do. It wants to be sort of expansive because you've got a Labour government, but it's got what feels like a bit of a squeeze going on at the minute. And then you've got Europe. Germany's is ripping up its own debt rules and is going on a dash for spending. And, you've got this argument that Europe needs to industrially retool to ensure energy security. It needs to retool to ensure national security. And that's going to involve spending. So you've got spending in stronger than expected growth in Europe and austerity and weaker than expected growth in the US. Europe's underperformed. The US has outperformed. Europe's not expensive relative to its history, and the US is. And I think that's probably part of the process why. Plus, with the other markets, they've underperformed the US. They're cheaper. Again, there's some growth there. There isn't necessarily the degree of policy confusion. And a weaker dollar is really good for emerging markets if you look at the charts historically. I know that's no guarantee for the future, but weaker dollar is generally good for EMs, and EMs of emerging markets have underperformed for what feels like forever. And so again, that's maybe why you're seeing some of these fund flows. Again, if you're a benchmark hugger, I get it. But when America is 66, 67% of global market cap and 7 stocks are a third of that, you're kind of all in a boat and everybody's to one side of the boat. And then eventually either the boat, everybody falls into the sea, or they go back to the other side of the boat and the boat rebalances. And I think that's kind of a little bit where we are now.
Keeping an eye on the boat then.
I will be. I don't like I'm not a strong swimmer, so I will not personally be queuing up for the chance to fall in.
Thanks very much for your time, Russ.
It's a pleasure.
Thanks so much to Russ for joining us on the show today. We've also got a second guest for you in the form of Tom Sieber from Shares magazine. Tom, you're going to talk about stock splits today. Can you explain to our listeners what they are and why companies undertake them?
Yes, thanks for having me, Danni and Charlene. Yes, so we're talking about stock splits. We've got an article in this week's digital magazine looking at stock splits. So, I mean, just to kind of really ground things for people who aren't that familiar, if you don't know a lot about investing or the financial markets, you might judge how expensive a stock is based purely on its price, the price that you pay for the shares. But actually, in terms of kind of genuinely being expensive, that's not the case. You could have a company whose shares cost £100, which could be cheaper based on the sort of traditional valuation metrics that people use than one whose shares cost £10. However, companies do sometimes look to reduce their share price through something known as a stock split. And I mean, it sounds a bit technical and confusing, but really it's relatively simple. So if you imagine you have a pizza and you cut it into more slices, you still have the same amount of pizza overall, but there are just more pieces to it. And that's effectively what's happening with a stock split. Company's total value doesn't change. They've just divided the existing shares into smaller parts.
Thanks, Tom. I like that kind of pizza analogy. That's really useful. So why would a company consider a stock split?
Yeah, it's a good question. So we've obviously said it doesn't really make any significant difference, in broad terms. But one reason companies might do it is that it actually can provide a boost to the value of the company. So there's been some recent research from Bank of America that shows that companies that split their shares see their share price increase by 25% on average over the next year, compared to a 12% increase in the overall market. And that might be one of the reasons for that is it might make their shares a bit more accessible to everyday investors. I guess, there are such things as fractional shares, but for people who are looking to invest a regular kind of small, relatively modest sum in the stock market, if they can buy, some share prices are so high that doing that wouldn't be practical because of the share price. And looking at some names that have in the past have done stock splits, Martin Gamble, who wrote the article for the magazine, has looked at what would have happened to their share price if they hadn't. So you look at a company like Apple. If it hadn't split its shares over the years, each share would now cost more than $50,000. And because they've split them, they're about $250 each. And Nvidia is another example. If it hadn't done 6 splits since the millennium, its shares would cost around $54,000 today. So it is, you can see how that makes it kind of more accessible to people.
Yeah, that's really interesting kind of analysis and comparison. Kind of with that in mind, are there any potential candidates, would you say, for a stock split?
Yeah, there's definitely are some candidates. You look at perhaps a company like Meta, say, that hasn't split its shares for quite some time. Netflix, which last split its shares a decade ago. Some of these companies have sort of share prices approaching kind of $1,000. So, they're getting to a level where that affordability issue or people feeling like they're more accessible is something that would become relevant. Another company people might be familiar with, Costco, the wholesaler, that's another business that might look to split its shares. There are some companies which have never done it and potentially, might never do it. So Berkshire Hathaway is one. Actually, they've done it once, but they haven't done it for a long time, and they're unlikely to. Although what Berkshire Hathaway has done is it's got another class of shares that are less expensive. So it's got an A class of shares that costs, the best part of £500,000 if you convert it into sterling. But they have B shares that are priced at a kind of a more accessible level. So it's something you've seen kind of more probably in the US than you've seen in the UK. But, having said that, there are stocks in the UK. Think of a company like Games Workshop, whose shares now cost, more than £140, that might consider looking at stock splits in the future.
That's a really expensive pizza when you put it that way, Tom, I have to say. But then if you could afford that kind of pizza, you could certainly afford a VR headset. And Charlene, that's one of the things which has now been included in the inflation basket. What is the inflation basket?
It certainly has, yeah. Whenever we talk about food on the show, it starts to get my my tummy rumbling. And in the inflation basket are also some everyday food items. So this inflation basket is something that the Office for National Statistics puts together, and it uses a basket of daily goods, of common goods that we buy, use, and consume, and it uses it to track price changes. Now, as times change and things come in and out of fashion, or, we have huge events such as the pandemic, that basket of goods and what is in it changes. And, we love it. I think we're quite nosy people on the show. We love delving into what investors are doing, what people are doing. And this is another part of it, really. So it's always really entertaining to kind of have a rifle through what is in that basket of goods. So this time around, I think 23 items have been added to the basket and 15 have been removed. So it kind of gives an indication of like the pace of change in lifestyle. So what is in? VR headsets. Danni, do you have a VR headset?
I absolutely do not, but I do have one of the other things which is in. A yoga mat. Yes.
Yeah. I feel like we have both of those in our house. I'm definitely the latter. I did buy my husband the former, although it was some time ago. So, ahead of the curve as always. And I mentioned food items, actually. Pulled pork, quite in fashion. That's replaced an oven-ready gammon joint that apparently used to be in the basket. I wasn't aware of that until we saw these stats. And other food items that are in, things like mangoes, smoked salmon. So, it's an insight into kind of how we might like to eat at home, but also kind of speed and convenience, perhaps. Other things that are in there, men's sliders, like the flip-flops. I'm not sure whether or not people actually are wearing them with socks, as I've seen in some of the press photos. Highly disturbing. Sorry to all the fashion heads out there who are probably laughing at me now. But, as much as we love kind of delving into it and being a bit nosy, is a really crucial indicator of what's happening with prices. And it's a data set that, obviously helps the Bank of England rate setters and also is used by government eventually with inflation measures to work out how much things like benefits, state pensions and train tickets should end up going up by.
What I love is to look back, though, at the basket of goods and see how it's changed. Because if you look back to the 1970s, home perms were in there. And of course, post-COVID, when we're all trying to go back and social distance, you had hand sanitizer that was in there for a while. And then it got ditched out, which I'm not entirely sure what that says about us, really.
Yeah, I mean, I do remember those messages, one good thing of the terrible times of the pandemic was people actually learned how to wash their hands properly. But if we're chucking the hand sanitizer back in the bin, then maybe that lesson wasn't that long learned. But it's I never had a perm. I can't say. And air fryers, they were obviously an addition. Was it last year? That and vinyl records. Yeah, they went back in last year.
Yeah. Really interesting, Charlene. Thank you so much to Tom Sieber from Shares Magazine and Russ Mould, AJ Bell Investment Director, for joining us on this week's show. Don't miss next week's show. We have got a spring statement special.
Yeah, I love that. A spring statement, a special alliteration. I mean, we thought it was a forecast. It's now a statement. It's not going to be a mini budget, don't panic. But we will be here reporting on the OBR updates and the forecasts and what the Chancellor has to say. Until then, thanks for listening. And we'd really love it if you left us a review of the podcast wherever you listen or download to your pods if you haven't already done so. Thank you.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.